Welcome back. You're watching Dukascopy TV. I have Christina Carlsten in the studio from Piguet Galland, who is an equities analyst. We're going to take a look at UK and European equities today. Welcome, Christina.
Thank you.
So, Christina, we have actually witnessed quite a broad economic recovery in the UK. So what are your views on this?
Yes, I would say that we have a broad recovery in the UK, and I would even say that it's broader than in the Eurozone. However, we have headwinds, we have the drag of austerity, and we haven't really seen a pickup in lending to corporates yet. I would even add that it's a very uneven recovery because we have on one hand London, which continues to attract a lot of businesses and capital from abroad, which is very positive for the employment and the real estate market. And then you have the rest of the UK, which is suffering from these austerity measures and the downsizing of the public sector.
However, UK equities still actually lag behind. So do you think we will actually see an improvement in 2014?
I think it depends on the way you look at the UK stock markets. If you look at the UK stock market as a whole, it is true, it's correct that it has been lagging because there are a lot of energy and material stocks in the composition of the index. But if you look more closely, you see that some sectors like the consumer discretionary stocks, real estate stocks or banking stocks have had a very good run, which suggests a lot of the good news is already reflected in the stock prices. So if you want to play a recovery, I think it's better to look at the Eurozone stock markets.
And Eurozone stocks were the top investment in the third quarter. Now, this was the best 3-month gain since 2009. So what are your thoughts on the trends and change in sentiments that we have seen?
Clearly, the sentiment towards European stocks has reversed since this summer because we had better economic news versus very low expectations, and we had a drop in political risks. And besides that, we had very attractive valuations on the stock markets compared to the US, for example. So now a big part of this pessimism has been corrected, but we think that the movement can continue because European stocks have been unloved during 5 years, which is a long period, and this takes time to correct. We believe that this movement can continue because Europe has been an unloved region during 5 years, which is a very long time, and this takes time to correct. But we think that in this rally, the US market will continue to lead and Europe will follow because there are negatives. European results for the third quarter were very poor, and we think that expectations for 2014 and 2015 may be a bit too high. So we have been very underweighted on the European stock markets since 2006, which was a bit early. And the recent developments of today makes us believe that it's maybe a bit dangerous and risky to be too underweight on these markets. But to become very positive or to make a structural case on European stock markets, we would need to see a catalyst. A catalyst would mean a big move from the central bank. What happened today, the drop in interest rates, is a first move in the right direction, but it's not enough. We have been underweight on the European stock market since 2006, which maybe was a bit early. But the recent developments make us think that it's today too risky to be too much underweight on these markets. To become very positive on the European stock markets, we would need to see a catalyst. A catalyst would be a big move from the central bank, and we think that what happened today is just the first step in the right direction, but it's not enough. Or we should need to see a depreciation of the euro. Because today the European recovery is very fragile, and there are a lot of threats still.
And what will be the main challenges facing both UK and Eurozone stocks for next year?
I believe it's very different challenges. I believe that in the Eurozone the risks are very skewed to the downside still, despite the move of the ECB today, because the fragile recovery could derail. There are a lot of threats still. We have the appreciation of the euro if it continues, and we are still in a deflationary context. And if this recovery derails, we would see an uprisal of political disputes and social unrest. Europe still has a lot of structural problems to cope with. And if we look at the UK, I would say the situation is quite different because the risks are probably skewed to the upside. And the challenge would be a normalization of monetary policy, which would temporarily penalize the stock market.
Christina, thank you very much for coming into the studio.
Thank you.
And thank you for watching Dukascopy TV. Do stay tuned as we have plenty more coming up. See you soon.